Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site is Joyce and Maddie Radner, both on the Nasdaq Market Intelligence Desk, and Justin Grooms. He is CEO of Bolt. We're here to discuss consumer spend trends and what retailers are cracking down on. It is great to have all of you with us, Justin. Let's kick this off with a brief reminder of Bolt and the kind of data that you see, which makes it really robust when you're thinking about the consumer trends that we're going to take a look at.
Yeah, thank you very much. So Bolt has been around for over a decade. We're America's largest e-commerce checkout platform, focused primarily on enterprise merchants. So the largest merchants out there. These are the Kendra Scotts of the world, the Revolves of the world. And what we have is we have 80 million American shoppers in our network, and we're able to see a significant amount of data over their entire shopping lifetime of what they buy, what they like, how they shop, what they return, and it's fascinating, the insights that we can see.
Yeah, it certainly is, because we had you on right in the middle of the holiday season, and some of those insights were really helpful in terms of determining how consumer spend trends could look over the holiday if they were strong as they were in 2023, and it certainly did play out that way, because again, more growth year over year.
Absolutely, we saw significant growth over the holiday season. We also saw significant diversity in that way that people were paying for things. Huge upticks, we talked on last time a little bit, in buy now, pay later options. Slight downticks in credit cards. This is something I think is really giving pause for some large banks. And what does this mean for issuers? And what does it mean for the BNPLs and how they evolve over time?
How do you think the banks are perceiving it, that you're seeing the move away from credit into BNPL?
I think the banks are coming up with a couple things. You're seeing partnerships like what we saw announced today between JP Morgan Chase and Klarna. And then you're also seeing new product coming out of the bank, which is essentially allowing some of that buy now, pay later functionality to be embedded directly into bank products that consumers already have. Your debit card, for instance, if you're getting it from a major bank, probably has pay in 4 capability built into it. That's something that a lot of banks right now are thinking, how do we get that message in front of consumers? So when they think about making a transaction, they know that that credit card or debit card or bank product that's already in their wallet can provide that functionality of pay in 4 that right now consumers are assuming they can only get with BNPLs like Klarna.
That is interesting, Maddie. Let's turn this into the macro backdrop for a minute, and with the consumer data that Justin is discussing, how is that reflective of the backdrop?
Yeah, I mean, I think right now tariff uncertainty continues to dominate all the headlines, which is frustrating because the macro backdrop is looking pretty strong. We did see GDP up 2.5% year over year. Friday's employment report showed the economy added 143,000 jobs in January. The unemployment rate ticked down, and inflation has fallen from its 9% peak in 2022 to just about 3%, which is close to the Fed target of 2%. But really, until there is more clarity on the duration and magnitude of tariffs, we'll still see supply chain uncertainty, which will really impact the consumer space.
Yeah, and Brian, let's take a look at what the charts are reflecting, the XRT, the retail index. Anything there that you can discern?
The retail index is very similar to the Russell 2000 consumer discretionary index, so it's not yet back above those 21 highs, but as you can see here, it is trending higher. Longer term trend from the say the summer of 2023, where basically it bottomed for almost a full 12 months, but really started moving higher in mid-23 to the fourth quarter. And so we've seen that trend of higher lows and higher highs underway. We've recently been pulling back over the last few weeks, like much of the broader market has as well, but we are still holding above that rising 40-week or 200-day moving average.
All right, Justin, let's talk about what retailers are cracking down on. And I had a little PTSD when I was looking at your notes, because part of this is around the return problem. And having worked in Foot Locker in the 90s, which was always busy, returns were always, we were trying to always figure out what the rationale was behind some of the behavior. What are you seeing from the data?
Absolutely. Well, I get to see information from two sources. One is from the large network of data that we see, and the other is from a lot of conversations that I have with executives at big retailers and big merchants of what they're seeing. What we're seeing across the board is that these executives have a good feel of what's happening inside their stores. There are a lot of returns that are happening. A lot of consumers right now, especially when they're buying wearable goods, are looking at almost to have that try-on experience at home. So these are people that expect to be able to return products and want there to be a very good experience. Retailers want to support these types of consumers. They can build a model around these folks, and this is a good behavior for them to see. They don't have, in many cases, brick and mortar dressing rooms that people can go into anymore. On the flip side, retailers want to be able to identify if there's individual consumers who, a very small segment of folks, but might be bad actors and might be trying to abuse the system. You worked at Foot Locker, I worked at Home Depot when I was in college, and I certainly remember just some absolutely comical examples of people returning items back to us that were, nothing like what they had purchased. That's something that's happening at scale right now with retailers. What they're trying to do is to build out programs that identify a more seamless experience for folks who want to return and are good actors, there's most consumers, and then help identify maybe some of those smaller segment of folks that they want to put up some hurdles or they want to create a little bit of incentive for those people to change their behavior.
Right. It's expensive if you have a really loose free return policy at the end of the day too. I mean, this impacts the bottom line for many of these retailers.
It is. It's very expensive, especially if the return practices aren't built into an intentional business model where you're developing a good relationship with the consumer. So some of our largest retailers that are in our network have return rates of up to 50%, but their business model is built around this. So they understand that consumers are going to want to try things on, they're going to want to look and see how it looks in their life, and then they're going to return it. If the retailer can identify who the consumer is, which is a big part of what they come to us to understand, then we can help them to understand, okay, these are the types of consumers that are likely to buy something again if you give them a really good experience on the return, or these are the types of consumers that maybe you should show them a different payment type that'll accelerate the speed that they get their refund if they do want it someday in the future. Those little insights can make the whole shopping relationship between a shopper and the retailer just more delightful and more personal feeling.
We'll get back to that in a moment here, but Maddie, I guess the silver lining to this is it's not that consumers are necessarily second guessing because they're worried about income, as an example. It's just a behavior more than an immediate need. It feels as if, because the concern is some of the optimism has come out a bit here.
Yeah, I think it'll be interesting to see if there are supply chain disruptions in the near future. How will these retailers respond? Will they try to absorb some of the cost increases, or will they try to pass that along to some of the consumers, but then they might experience some of their volume and sales suffer. So it's all uncertain right now, but if costs do remain elevated or increase, they're going to have to figure out different ways.
Especially in the consumer and retail space, your margins are, it's such a fine balancing act.
Yeah,
right?
And when we look at the economic data, small business optimism, for example, we did see a pop following the election, but that's since been reversed. And we are seeing small businesses facing hiring challenges, which is interesting. They're struggling to find qualified workers. So not only are goods maybe increasing in cost, but they're not finding workers to assist with their business. Yeah.
Brian, if we take a look at the relative strength of consumer discretion versus staples, anything you can see from there? Is there a divergence of performance?
No, it's certainly positive. We bottomed in late 22, just like the broader market did, and when the stock market has since been rebounding, this ratio with discretionary over staples, you would expect to see this going higher as well, and we're just 2 weeks away from the cycle highs, and so from that perspective, that relative strength is aligning up with the broader strength we've seen in the marketplace, particularly with consumer discretionary sector, which has been doing very well the last 2 years. Now it's heavily weighted to Amazon and Tesla, but even if you look at the equal weight index for consumer discretionary, that's also outperforming the equal weight S&P 500.
Yeah, well, let's take a look at one area of concern, the home builder stocks, in homage to your time at Home Depot. Down 30% from their Q4 highs. Any signs of recovery? Any conjecture in terms of why the sector's under pressure?
Yeah, so this is a sector and industry I've been paying particular attention to. From a stock market perspective, home builders and semiconductors have been up fivefold since the 2020 lows. Home building in particular is, certainly has a big impact on the economy, and we've seen, the top 3 to 5 home builders in the United States down 28 to 35% from their Q4 highs. The broader ITB ETF is down about right now 20% from those highs, but you can see this multi-year uptrend. It's been tested a number of times, so that tells me from a market perspective, from a price perspective, that it's important, and it seems to now really just kind of be, in this sort of sideways consolidation pattern. Whether or not that breaks down below, that recent support around 97 to 100 is what's important. You know, just because it's a somewhat looking topping pattern, it doesn't necessarily have to break down. It could just be a sideways consolidation, and then we resume the uptrend in time. But you know, we are seeing elevated rates,
Right.
And a lot of uncertainty with what's kind of going on.
And I think that's reflective of the broader conversation that we're having. You know, if you don't have operating clarity, it can be challenging, you know, even when you think about not where you're going to invest your money as an investor, but as a corporate, how you're going to allocate for R&D and future growth and so forth, if a lot of these variables can impact your operating strategy.
Sure.
Yeah. All right, so let's talk about demographics for a moment here, and who are the culprits of the return problem?
That's the challenge. The challenge is that the classical demographics based on age or income or gender are not very informative for us in understanding who is going to potentially return, or what type of return behavior more accurately we should expect from them. So that a lot of retailers, what they're trying to understand is more subtle signals from these consumers that we can pull out of a large network of shoppers that can indicate a series of patterns over the consumer shopping behavior. We expect these types of returns or not these types of returns. That's what's so interesting about this. It's not easy to bucket people into different spaces.
You know, because it's interesting, it's noted that millennials have the highest return rate compared to Gen Z, with the lowest return frequency. I mean, if you think about this from an existential perspective, I wonder if Gen Z is more concerned about perhaps the greater good, where if you keep returning, it's going to increase cost to consumers. And it seems to be reflective of other surveys that we've seen and their concerns around that.
There are a lot of theories about this of what is driving different people, different groups to have different return behavioral in general. I think sometimes what a lot of the retailers that we're looking at are trying to understand is, are there returns that they could be getting in front of that actually represent the consumer wasn't able to fully appreciate the purchase before they ordered it? Can we do a better job of helping them to appreciate how this would look, how it would feel? And then the other big thing that these retailers are frankly focusing a lot in right now is understanding how different folks can pay, because a big hidden cost for these returns for retailers is payment costs that are built in. They're losing a couple percentage points for transaction fees on these sales, and depending on how the payment type is, how much they get back, that retailer gets back when the item's returned, can vary dramatically.
Right, when I think about it, 2-3% in a high ticket item, that does add up to the bottom line here. But it's interesting when you think about the demographics again, even being able to explain from, conception to the supply chain to the product, and this is how it got here. We started off in this country, it's here, we shipped, we did this. And explaining the process or the journey or telling a story seems to be an attractive way to get younger demographic attention as well.
Absolutely. I think that, consumers want to understand in many cases where their product came from. This started with the Made in USA label years ago, or Made in Italy, or Made in wherever labels years ago, and it's really come into, can we tell a story? But part of this, from a retailer's perspective, is the trade-off on attention. How can I understand this individual consumer and what data is going to be useful for them in making the transaction? Because I only have so many pixels on the screen to share information. I can overload someone. So if I can understand who that consumer is, which is the big thing that retailers are trying to figure out, I can understand this is what they're most likely to care about in this transaction. This is the way they're most likely going to want to pay. Or here's options of how things could be shipped or paid for that maybe they hadn't thought of before.
Yeah. Amazing insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.